Welcome back to Switzer on Australia's Business Channel. Last time we spoke to Gary Stone from Sharewell Systems, he was bullish and fully invested, but with these worrying winds from Broadway, not Wall Street, as I explained earlier, is he wavering or has he already gone negative and sold? Let's find out. Gary, how are you?
Very well, thank you, Peter. Thanks for having me on again.
My pleasure, mate. I hate to put pressure on you, but you know, you're a man who knows his market and the way he wants to invest. So the viewers are wondering, are you wavering with the negativity coming out of Broadway, not Wall Street?
Well, Peter, being human beings, we always get affected by the negative news to some degree or another, but that's why I have to go back to my investing rules, and my investing rules at this stage are saying, certainly for the Australian market, that we are still to be fully invested. Now, that doesn't mean I know what's going to happen. It just means that you know, the big picture perspective over 30 years of research, looking at 30 years of way markets move, is that it's still not time to run for the hills yet. So
30 years. So you must have started doing this when you were 10. Is that right?
No, I started doing this when I was about 29, 30, but the research that I've done over the years goes back to around about 1980, certainly in the Australian market, but back to the 50s on the US market.
Okay, mate. So what is probably the most convincing reason why you're still strongly committed to the market?
Well, Peter, the indicators we use are weekly indicators, and if you look at the week-on-week move on the Australian market from the middle of February to current, we haven't really gone down enough to say from a momentum perspective that it's time to run for the hills yet and get out of the market. Certainly our indicators have given sell signals on the United States market, so all three of the major indices there have told us to go into cash, so we're going into cash on the US market, but the Australian market on a relative basis on the last 3 weeks has outperformed the US market, so we've held in there to a larger degree than what the US markets have.
And do you get any indicators from other markets other than Wall Street?
Well, I do keep an eye on the DAX. The DAX went what we call high risk about a couple of months ago, and it didn't recover sufficiently after that to get us back in. So we would have been, but we don't trade the DAX, but if we had been trading the DAX, we would have been in cash a couple of months ago. So that is another index that I do look at. That's a volatile index. It's similar to the Nasdaq in that sense, but otherwise, if you look at the European markets, the FTSE has also gone high risk, and so all around the market, all around the world, we are seeing equity indices giving us exit signals, but not on the Australian market yet.
Interesting. Okay, so let's go to your charts, Gary, and before they put them up, tell us what the chart's going to show.
Okay, well, the first one is an interesting one, and it's one that people would not take much note of, but it's a relative strength chart between the ASX 200 and the All Ordinaries, which is effectively an ASX 500. So it has another 300 stocks in it that make up the index.
So which one's which, Gary?
Okay, the top one is the ASX 200, but the chart that we need to look at is the bottom chart, which is the relative strength chart. So what that does, effectively, the maths behind it is you just divide the one by the other, and on a relative basis, if the line on the bottom chart, the relative strength chart, is falling, so if it's going down, that means that the ASX 200 is underperforming the ASX 500. So if the bottom chart is rising, it means the ASX 200 is outperforming the ASX 500. So what that does is give you an indication on what the smaller to mid-cap stocks are doing relative to the large cap stocks. It's a good way of getting an idea of where the smart money is going in the market.
So are you saying that the smaller caps are doing better now?
Well, they did start doing that in the second half of last year. That started happening, right? And that's where I've got the big green circle on there. You can see that it was falling. That bottom chart was falling, which meant that the ASX stocks from ASX 201 by market cap to ASX 500 were doing better than market cap 1 to 200. which is an indication that the smaller to mid-cap stocks are starting to make some ground up. And that's what I've been keeping an eye on, amongst other things, to see if we were going to get this run on the smaller to mid-caps. And that was the first sign. It was showing that maybe it was going to happen in our market. But alas, you can see on the very right-hand edge over there, over the last 3 weeks, there's been a shift into the large cap stocks quite strongly in the Australian market.
Yeah, the tail has gone up. Okay, so let's go to your next chart.
Okay. Well, the next chart is just a matrix, if you like, of the breakdown of our market in Australia, just to give an insight into what happens here. And what I've done is I've taken all of the stocks with less than $1 billion market capitalization, and that is 92% of our market have a market cap of less than $1 billion. So that leaves about another 160 stocks on our market with greater than $1 billion market cap. So roughly ASX 200 to the rest. Now, the interesting thing is that the energy and materials make up 60% of our stocks that are less than $1 billion. Now, that is a huge weighting. That's the number of stocks, a huge weighting towards energy and material stocks. And you can see that the next one down is financials, 10%, and then industrials 8.5%, and pretty much nothing on the rest. And the interesting thing here is that the breadth of our market is pretty narrow. And not only is it the breadth that's narrow, it's also the liquidity that gets pretty narrow as well. So we suffer in this market from lack of breadth and lack of liquidity relative to other international markets, particularly the United States markets.
Okay, now you've got another one where you actually put Nasdaq up against it. Is that right? Another chart?
Correct. And the next one shows and I've done a similar thing on the Nasdaq where I've taken less than $2 billion, and I was trying to get close to that 92%. So less than $2 billion market cap is 86% of the Nasdaq. But look at the spread. We think that it's information technology stocks now. In the Australian market, we have information technology is 5% of our small caps, and the Nasdaq is 22.6%. But the financials make up 22%, and health make up 20%. That's those biotech stocks on the Nasdaq. So there are a lot of other stocks. It's not just an information technology index as its kind of reputation tells us. But there's also industrials 11%. So there's a far better breadth of market on the Nasdaq, and it's a lot more liquid as well. So this combination of liquidity and breadth gives opportunity to trade there. And the vice versa here in Australia, obviously, our market lacks that.
Yeah, but I guess the stocks that are really driving the Nasdaq down would probably come from infotech and the healthcare sector.
It's the large, obviously the large market cap stocks, when they move down, have a big negative effect. So what you're seeing is it's the large cap information technology stocks in the Nasdaq that are pushing the index down. But there's a bunch of others out there that are not doing as badly as that, but they do get affected. There's no doubt about it. Okay, so everybody is fascinated at this research, Gary, and we take your hat off for it. But how do we use it to make money? Well, very good question, Peter. So in a market like Australia, it's far more of a stock-picking market than because of the lack of breadth and the lack of liquidity. So when we see the very first chart I show you the ASX 200 starts outperforming the ASX 500, you very quickly have got to say, right, I'm just not going to take any risk outside of large cap stocks. But you can also go to other indices like the small cap industrials, the mid cap industrials, small cap resources and mid cap resources, and look for signs there as to whether those indices are starting to rise. If they're not, if anybody's talking about, either on shows like this or newsletters or whatever, the odds are heavily stacked against you if you start going into those areas of the market. Sure, you might get the odd one go up here and there, but the odds are stacked against you. And what you should do in times like this is just stick with the large cap industrial stocks. Yeah, it's interesting because this year it was actually those stocks from 50 to 100. They've done very well. They've got Seek and REA and Ramsey and those sorts of companies, but they now obviously are being clobbered. So are you of the opinion then the place to go is back to the top 20, top 30 stocks? Well, in this market, it would be. You know, if you want to be invested, I mean, the way I invest is I invest in a cash equity strategy. So I'm either 100% in cash or I'm 100% in the market. So I'll step right aside from everything. But people that have got large amounts of money in the market don't want to just tip out of everything, or want have got the 90-85 rule where they've held stocks for a long time and they can't sell. It just comes back to buy and hold. If you're going to be a buy and holder or a long-term investor, you've got to go with the large caps with that pay dividends and just ride through periods like this. But if you're going to be active, well, then you have to be you have to be nimble and agile and move in and out of certain parts of the market and back into them when the times are good again for those areas.
But Gary, have you looked at companies like Seek and REA Group have now fallen around 15%, and have you evaluated whether they're worth a buy now?
Well, absolutely. I mean, you were talking about Xero earlier. I was in New Zealand last weekend, and it's the second largest stock on the New Zealand market by market cap. And we don't even know what its financials are yet. But a stock like that, our system gave an exit signal on the way up at $30, and it did not give a re-entry because it had got too volatile on the upside. And I remember people were saying to us, well, how come there's no re-entry signal into the stock? Well, it had got overbought, and now it's fallen to below $30 and probably going to go lower. But REA, REA has been a brilliant stock to buy and hold. But we had exit signals out of that 2 weeks ago. We had an exit signal out of Flight Centre. Sorry, not Flight Centre, Magellan, which is one you didn't mention earlier, but it's also been in that stratosphere type thing. We had exit signal out of that a few days ago. And Ramsey also a week and a half ago. So our medium-term signals have been getting people out of these, but obviously we would have traded them on the way up as well. So we wouldn't have been in them all the time on the way up. We would have got in, got out, got in, got out, just waiting for that time that eventually when they do fall over, we don't want to be in them when they have a 25, 30, 40% fall.
Yeah, but now they could well get oversold. So does that automatically mean that they become rebuys at these lower levels?
Absolutely, but we wouldn't. The mechanics of our rules wouldn't get us in on the way down. They'd have to base and prove themselves again. Yeah. And one of the first things they have to do to prove themselves is they have to start outperforming the overall market again to say, right, we're on the way up again and we're performing better than the market, and then we'll time our way back into those. Okay, one final one. Have you thought about Coca-Cola? Has that been one of your companies and has copped it recently? What's your view on it now? Well, I had a look at it today. It was down the last time I looked in the last half hour, it was down nearly another 7% today on the 13 or 14% on Friday. No, I started looking at the Fibonacci levels. It's getting pretty close to the 50% retracement level, which for me is a point of control. I think it's going to be it's getting to a point where I think it's going to technically it's going to find some support. But it would be a bottom pick if you try to get into it now. Don't try and catch a falling knife. Wait until the knife's landed and stuck around for a while, find out which way it's pointing, and then have a look at it again. Yeah, I should explain to the viewers that your technique is based on, okay, if it's falling, let it fall and start to see whether the trend goes up. And you don't care if you miss out for a while. It's as long as that trend's been established, then you're happy to get in. Correct. It has to reprove itself. We need to see some price action evidence that buyers are in control of the price action again. Okay, Gary, thanks for joining us on the program, mate. Yeah, it's a pleasure, Peter. Talk to you soon. Okay, that was Gary Stone from Sharewealth Systems. After the break, we'll tell you which sectors should find your favour in this period of volatility.